Let me start with you on the broad market action here. The index continues, the S&P quite resilient here, barely down for the month. That's thanks in part to the big growth stocks doing a lot of the work on the upside last week. But also, we're at one of these moments where central banks rescuing the financial system with liquidity measures. Maybe the Fed's going to be done earlier than we thought. Are those things that you think can continue to support this market or not?
Well, first, Mike, great to be with you. It's nice to see some green on the board today. As far as our positioning, at the end of January, early February, after that rally, we actually went to more defense and took some money out of stocks and raised a little bit of cash. And right now, as much as the market's been exciting, we see it as somewhat unexciting. So we're still more in that defensive position, even if the Fed decides to pause, or a lot of people are looking towards the end of the Fed tightening cycle. History suggests that is not a cure-all, especially if economic data weakens later this year, which is our expectation. But Mike, I think part of the reason you have this balance, this tug of war right now, because the Fed came in, the overall market's acting pretty orderly as a whole. But if you look at the overall market, you're still trading around the 17 multiple with above average macro risk. In the fixed income market, we've been overweight high quality, but yields have come back quite a bit as well. So in our view right now, it's good to be somewhat defensive and patient at this point, because we're not seeing any really compelling opportunities across the capital market space right now.
So with what's going on in financials or the severe pullback in some energy areas, none of those things feel like they're timely for you?
No, the first thing with financials, after you see a shock period in the market, typically there's a long period of basing and back and forth, and they get somewhat quiet after you see these shock periods. So in our view, we're more or less neutral in financials here. And then energy, we had been overweight most of the last year. We downgraded that early this year. I do think the structural case for energy is still there. So if you have a longer time frame over the next 1-3 years, I think fine. I think the challenge that energy had is that it just got overcrowded, and then energy prices have come down quite a bit. But it is one of the cheapest sectors. But again, that's also where we're more neutral. I mean, the one area that we're still overweight, Michael, is industrials. We still think there's some structural positives for that sector as far as reshoring. We think this strategic battle with China is going to mean defense spending will continue to move higher as well. And then also the stimulus bill that was passed last year was underappreciated. There's hundreds of billions of dollars of infrastructure spending happening in the next several years. So we do like that sector. But again, there's times in the market to be tactical. That's one of our key themes this year, is to be tactical. And we did that with the market move up earlier this year. But at this point, you don't have a fat pitch. You're in the middle of this kind of 3,800 to 4,200 trading range, and interest rates have come down. So it's okay to be a little bit patient. We have high conviction that there will be better opportunities to deploy capital.